my first year in Canada, I invested more than $25,000 in the US and Canadian markets. Although I didn't have a job when I landed here, I had expenses moving to Toronto, setting up a first home here, while also figuring out the right avenues to invest in. And having started from scratch here, I figured out a formula that worked for me. And so in this video, I'd like to go over my formula, talking about how I achieved this so that you can too. But first, here's some context in case you were wondering. Am I new to investing? No. I've invested before in the Indian and US stock markets back when I was in India. So then the question is, am I an expert in investing? No, not at all. I'm no financial expert and I'm definitely not here to give you investment advice.
I did not go to business school, so it's not the same thing at all.
Do I have a shitload of money just waiting to be invested? Yeah, of course. And you don't?
Well, aren't you cocky?
Wow, how I wish that was the case. But I'll tell you what I do have. A system to help me invest regularly, which I then leave to grow within my accounts. And I'll talk more about this later in the video. So, if I can build this portfolio from ground zero in my first year here, then I'm certain you can do it too.
I would like to give you the only copy of Somehow I Manage.
Let's get into the first step of my formula. What not to do. People get so caught up with investing that they sometimes completely lose track of the main goal here, which is to allow your money to make you more money in the process. And the only way you can do this is by having money in the first place to invest, which means you need to 1. Make money first. Duh. This goes back to a couple of things I mentioned in my previous videos. You need to either find the right job or source of income that fulfills you both mentally and financially. And secondly, save a good portion of that money so that you can invest it. I'll leave a link to the video how I saved more than 60% of my salary every month at the end of this video. Stick around for that. And 3, this is the most important part. The amount you invested needs to stay invested. Repeat after me. Stay invested.
Stay.
Remember, time in the market always beats timing the market. Here are some ridiculous numbers and facts to back this up. Warren Buffett, whose net worth as of making this video is around $132 billion. But did you know that more than 99.6% of that he made after he turned 50? I mean, he wasn't even a billionaire at the age of 50. I think he hit that mark only when he was 56 or so. Which is just ridiculous, right? He wouldn't have gotten there if he didn't stay invested in the market for all those decades. Let me give you another one. Over the last 20 years, if you invested say $10,000 in an S&P 500 index ETF, your money would have grown by about 10% compounded annually, resulting in about $65,000. But what if you try to time the market and miss the 10 best days in the last 20 years? Well, your portfolio would be less than half of that, just 5.6%, about $30,000. And missing the best 20 days would cut your return by more than 70%, which means you'd only have about $18,000 left. That's not just crazy, but also painful.
Where's the rest? The money, Skylar, where is the rest?
Imagine losing more than half of your portfolio because you were trying to be a smart ass and time the market. So I hope I've convinced you to not time the market. Also, don't spend hours, days and weeks studying the market and then following the market every day and trying to buy low and sell high on the same day or week. That is called day trading or just trading and not investing. And what you should be doing instead is investing for the long run. I need to also stress on the other side of the equation too. Don't get into investing if you don't have liquidity.
Don't do that.
That is why in my previous videos, I've been stressing so much on the importance of following a particular order of saving and investing your money. The market is super volatile. If for some bad luck you have some emergency or an unforeseen expense pop up, and if you've invested without having solid liquidity or savings, then you might need to pull money out of the market prematurely. And if the market's down at that point, then you're going to lose some significant amount there. So don't put money in the market you need in the near future. The name of the game is stay in the market. Stay. If you're still not convinced, allow Taylor Swift to convince you. Thanks, Taylor. Well, now that we got that out of the way, let's next talk about becoming financially literate. It's important to understand what you're working with in your country to make the most of what the system offers. For instance, I live in Canada and there are numerous tax benefit accounts here like the TFSA, RSP, FHSA, etc. If you're in the US, then you'd have accounts like the traditional IRA, Roth IRA, HSA, etc. Basically, these accounts help you save on taxes, be it capital gains or reducing your income tax. And the more you can save on taxes, the more money you get to keep, and in turn, more that money makes you more money. Wow, that's a lot of money. And while this can sound boring and tedious, I would highly recommend understanding the investing landscape in your country so that you come up with a system that works for you. So maybe this is fate sending you a signal to subscribe to my channel so that you can check out some of my other videos where I go into details about all this. TLDR, subscribe. Anyway, I'm no financial expert. On the contrary, I used to ignore finance and investing for the longest time. And then when I finally realized that my money was just losing value because of inflation, I decided to buck up and do some reading and learning on the topic. I'd created a video on my previous channel back in India, which is now unlisted, where I went into the process of how I learned to invest in 15 days. The principles are pretty much the same here. So let me know in the comment section if you'd like to see this video. If there's enough interest, then I'll re-release that video here for all of you to check out. While I am for the idea of investing in broad index funds or ETFs, which I do by the way, I also believe that bigger and more substantial gains can only be made by investing in the right individual company or stock. And so I've learned how to analyze a company and make a calculated assumption. And trust me when I say this, every financial expert or analyst on earth is also doing just that, making calculated guesses or assumptions when it comes to stocks. Again, I'm no expert, but my process sure works for me. Another big reason to do all this is because you don't want someone else managing your money or fund, because most of the fund managers are unable to beat the index, and they also charge a hefty fee just for managing your money, which basically results in you not making the most you can from your investments. And so if you want to build actual wealth, you'll have to spend some time understanding the nuances of investments. It's only because I studied the US market, the Canadian market, the Indian market too, I'm able to confidently invest my money and also make these videos for you folks. What I can assure you is if you're curious and driven to learn about it, it's going to take you far lesser time than what you think. It's just a matter of getting started somewhere. Utilizing the employer match program. Like I mentioned earlier, you need to find the right job that fulfills you both mentally and financially. And so let's focus on the financial aspect here. Finding a job that not just pays you well, but also offers good benefits. And one such benefit is the employer match program. This may not apply to all jobs or all of you watching, but I would recommend that if it doesn't apply to you now, then this is something to keep in mind for your next move. With this, you can opt to have a portion of your salary deducted that would be transferred to your retirement fund, your RSP, or 401k. This is probably the easiest and most beneficial way to get started with investing for numerous reasons, the biggest one being that you don't even need any money to get started. I mean, normally you'd have to save some money and then invest it, right? But with the employer match program, it basically gets deducted from your salary on payday. And it usually automatically gets invested too, which means this kind of becomes a passive method to invest. And not to mention, your employer matches the entire or a portion of your amount and contributes it to this fund, which also means that you're getting free money. That's 3 massive benefits packaged into this one benefit that your employer offers. Another benefit that you can look for in an employer is an ESPP, or an employee stock purchase plan, where you're allowed to purchase your employer's stock or share at a discount or locked in price. Or you could have a program where they match a certain amount that you contribute to buying the company stock. Basically, they might have some stock related benefit offering, and this too is something I would highly recommend opting for, provided you believe in your company's future. In my case, I opted in for both the employer match as well as buying company stocks, and this has definitely grown my portfolio considerably. So it's worth spending some time to see what your employer offers, or at least worth keeping in mind when you make your next move. Come up with a personalized formula and system. Now I've explained everything to you from my perspective. Some that might make sense to you and some that don't. And that's fine too, because this is my perspective and formula on how I invest and grow my money. If you vibe with anything I've shared here, then by all means, please make a note of it and figure out how you can utilize it to your benefit and personal circumstances. And that's the biggest thing I want you to take away from this video. You need to find the personalized formula system that works for you. Like when I moved to Canada, I was so excited to start exploring the Canadian market and investing in some of the Canadian stocks, which I'm still invested in to this date. Also, all the online brokers here make it so much easier for you to invest in Canada instead of the US or any other country for that matter. And I saw that there are numerous Canadian YouTubers and residents here who invest very heavily in Canadian instruments and stocks, so I was ecstatic too. This is a phenomenon called home bias. Let me get financial expert Morgan Housel to explain this to you better.
There's this well-documented home bias with investors where, by and large, people who live in America only own US stocks, and people who live in Germany only own German stocks, and Japan, so on. People own the stocks that are closest to where they live, which is not rational at all. It's not rational to think like the best stocks are the ones that are closest to your house. That's crazy. But that's how people invest. And it's not rational, but it's actually very reasonable. If taking the leap of faith of investing your life savings in these companies, if it's easier to do that when you're most familiar with them, that's totally a reasonable thing to do. And so I think that difference between reasonable and rational is really important.
And so rationally speaking, I quickly realized that the Canadian ecosystem isn't probably for me, and I noticed that the US and even Indian investments made far more financial sense for me. The point is, you need to find an approach that fits your goals and your risk appetite. You need to choose an approach that ensures you get what you want from your investments, which also lets you sleep peacefully at night. For instance, I'm not going to buy a house anytime soon to live in until I have my other investments and assets sorted. Why? Well, I personally see too many downfalls with housing compared to other investment instruments. Also, hot take, the house you're living in is technically not an investment. It is an asset, but not an investment in my opinion. Because investments are technically meant to be for profit, and you would have a hard time selling the house you're living in unless you plan to move to another house years later. Anyway, you may not vibe with that thinking, and that's okay because like I said earlier, it's my perspective and approach, hence personal finance, right? Hoping that my personal approach helps you define and find your personal approach to investing. If you'd like to learn about the specifics of my investment strategy and how I diversify my investments, then let me know down in the comment section and I'll release a part 2 to this video. As promised earlier, here's the video of how I save more than 60% of my 6-figure income every single month. Also, after all that I've said, if you're still hell-bent on buying a house soon, then you can prioritize some of your investment accounts smartly to save you quite a bit of money. This video here will help you with the perfect order of investment accounts for that purpose. Thanks for watching, and I'll see you on the next one. Or probably here.